Welcome to Talk Tickers. We're jumping straight into the recent earnings call for US Foods Holding Corp. Our goal today is to really break down the key numbers, the management commentary, and figure out what it all means for you.
Yeah, it's an interesting one. This quarter really shows a company navigating, well, let's call it a mixed economic picture, but finding some real success in key spots.
Okay, let's cut to the chase then. The headline numbers. Q1 2025, net sales hit $9.4 billion.
That's right, up 4.5%, which is pretty solid. And their total case volume also saw a bump up 1.1%.
1.1% volume, okay. But the profitability numbers looked even stronger, didn't they?
They did. That's where it gets particularly interesting. Adjusted EBITDA grew 9.3% compared to last year, came in at $389 million.
Wow, 9.3%. And that fed right through to the bottom line, earnings per share.
Exactly. Adjusted diluted EPS, it shot up 26%. 26% to $0.68.
That's quite a jump.
It really is.
Yeah.
And it shows strong earnings power, especially when you consider, the challenging backdrop. They mentioned severe weather causing some disruptions too.
Right, the weather impact. They also announced a pretty hefty share buyback, $1 billion.
Yeah, a new $1 billion share repurchase program authorized by the board.
What does that usually signal? Confidence?
Generally, yes. It suggests management thinks the stock might be undervalued, and it's a way to return cash to shareholders.
Yep.
Another key point was the Chef Store update.
Ah, yes. They were looking at selling that division, weren't they?
They were exploring strategic alternatives, yes, but ultimately decided against a sale right now, cited the current macro environment.
So holding on to it for the foreseeable future, how's Chef Store actually doing?
Performance-wise, its EBITDA growth was actually in line with the rest of the company. And, context is important here. It's less than 5% of their total EBITDA anyway.
Okay, good context. So not a huge drag, performing okay. Let's dig deeper into that overall volume growth, 1.1%. Where did that come from?
Right, because it wasn't uniform across the board. The independent restaurant segment, that was a bright spot. Case volume up 2.5%.
2.5% for independents is pretty good.
It is, but it could have been higher. They estimated that severe weather took off about 160 basis points. But interestingly, that was somewhat offset because they were lapping some labor disruption issues from last year.
Ah, okay. So a bit of noise in that number, but the underlying trend sounds positive.
Definitely. They said organic independent case growth really picked up steam from February into March, and that momentum carried right into April.
Oh, really?
Yeah, they even mentioned hitting their highest cumulative independent case volumes of the year in the last 3 weeks of the quarter. And April was their best month all year for signing up new independent accounts.
That sounds quite bullish for that core segment then. What about other customer groups? Healthcare?
Healthcare was very strong, grew 6.1%. That marks, get this, 18 consecutive quarters of growth in healthcare.
18, wow.
Yeah, they see themselves as the leader there and are pretty confident about continued growth. Hospitality also did well, up 3.6%.
Okay, so independent strong, healthcare very strong, hospitality solid. Where's the weakness then?
It was the chain restaurant business. Volume there was down 4.3%.
Any specific reason given?
Management basically pointed to the broader industry trends. Foot traffic challenges that are affecting a lot of the big chains right now. So less a US Foods issue, more a market thing.
Got it. Makes sense. They also talk a lot about their strategic pillars: culture, service, growth, profit. Let's touch on those. Culture first. Safety seemed like a big point.
It did. They reported a 12% year-over-year drop in injury and accident rates, which is good. And even better, 38% down over the last 2 years.
That's a significant improvement.
Absolutely. Likely helps with workforce stability, productivity, all that. They also mentioned boosting community support, like a donation to Giving Kitchen and renewing their Red Cross partnership.
Okay. And on the service side, they said best service level since 2019.
Yeah, and they backed that up with a metric, their Operations Quality Composite, or OPS-QC. Tracks things like on-time order accuracy. That improved by about 20% year over year.
20%, that's substantial.
It is. Their best performance since Q1 21. A big driver there seems to be the rollout of their Dart routing platform.
Ah, the route optimization tech.
Exactly. It now covers nearly 70% of their miles, and they expect full deployment by year-end. That's clearly helping efficiency. They also launched a generative AI tool for their sales team's order guides.
Interesting. And they linked that to the faster new account generation in April.
They suggested it contributed, yeah. Seems like tech investments are paying off there.
Okay, how about the growth pillar? Any specific initiatives highlighted?
Definitely. the Pronto small truck delivery service. They're continuing to invest there. It's now in 10 markets, aiming for 20 by the end of 25.
And is it working? Is Pronto driving growth?
Early signs are positive. In the pilot markets, they saw a 10 to 15% lift in overall case growth from customers who started using Pronto.
10 to 15% uplift, that's not insignificant.
Not at all. Plus, they mentioned onboarding over $100 million in new annualized business wins, specifically in healthcare and hospitality.
That's a good pipeline, Phil.
Yeah.
And their private label, Scoop.
Still going strong. It crossed $1 billion in annual sales last year. They just launched their spring Scoop line with 18 new items. Private label is clearly a big focus.
Which ties into the profit pillar, I assume. Adjusted gross profit was up 5%?
Right. That $1.6 billion figure was driven by, well, the volume growth we talked about, better cost of goods savings from suppliers, and that increasing private label penetration.
How high is that penetration now?
Company-wide, it hit 34%. But for their core independent restaurants, it's over 53%.
Over half their volume to independents is private label. Wow.
Yeah, it's a key lever for them. Likely helps their customers manage costs too. They're also making progress towards that $260 million cost of goods savings target under their long-range plan.
And what about internal costs? Labor.
Good progress there too. Significantly better retention in the supply chain. Selector turnover improved by about 20 percentage points. Driver turnover down low single digits.
That stability must help control costs and maintain service.
For sure. And on top of that, they mentioned taking out more administrative costs this year beyond the $120 million in savings they achieved last year.
Okay, lots of moving parts on the cost side. The CFO commentary probably shed more light on the financials.
It did. Confirmed sales increase was both volume, the 1.1%, and then 3.4% from food cost, inflation, and mix.
Okay, so inflation's still a factor.
It's still playing a role, yeah.
Okay.
The adjusted EBITDA growth came from that volume, the gross profit gains, and what they call operating expense productivity. Basically doing more with less, leading to better operating leverage.
Did the margins improve?
Yep. Adjusted EBITDA margin was up 18 basis points to 4.2%, and adjusted EBITDA per case increased too, by $0.15 to $1.90, so more profitable per case delivered.
And cash flow looked strong.
Very strong. Operating cash flow jumped to $391 million. They used some of that cash, $23 million for share buybacks, and $92 million to acquire Jake's Minor Foods.
And they signaled more buybacks coming.
Yeah, committed to more meaningful share repurchases for the rest of 2025. Their leverage is comfortable, 2.7 times within their target, and significantly, S&P upgraded their credit rating to BB+ LAMP.
That S&P upgrade is a nice validation. So how does all this translate into their outlook for the full year? Did they change guidance?
No, they actually reaffirmed their main guidance points, still expecting adjusted EBITDA growth of 8-12% for the year, and adjusted diluted EPS growth of 17-23%.
Holding firm. What about the sales and volume assumptions underpinning that?
Slight tweaks there. Overall sales growth still pegged at 4-6%. But they now expect a bit more from inflation and mix, around 3%, and a bit less from total case growth, now 1-3%.
Okay, so the mix shifts slightly, but the overall profit targets remain.
Exactly. Independent restaurant case growth specifically is guided at 2-5%. Other modeling assumptions like CapEx and interest expense remain unchanged.
Did they touch on any bigger picture macro stuff? Tariffs, for instance?
Briefly. They're monitoring tariffs, of course, but said imported goods are a relatively small part of their business, maybe mid to high single-digit percentage potentially affected.
And the overall economy, resilience.
Yeah, they emphasize the steady growth in food away from home spending. And they really stress the resilience of their model through different cycles, said their self-help initiatives are still in the, quote, early to mid innings.
Meaning more room to run on efficiency gains.
That's the implication. And they have levers. If demand softens, cutting discretionary spend, pushing harder on productivity, maybe slowing down some capital projects, they noted about 80% of their distribution operating expense is variable.
Gives them some flexibility. How's the competitive landscape looking? Still tough.
They described it as, well, consistently competitive. Smaller regional and local guys keep the pressure on. But importantly, they see the larger players, themselves included, continuing to take share.
So consolidation trends continuing. Any change in promotional intensity? Price wars?
Apparently not. They said no significant change observed recently.
Okay. And digging into some of the nitty-gritty operational stuff. Lines per account, drop sizes.
Lines per count, pretty stable. But drop sizes, meaning cases per delivery, were actually down a bit in Q1. They tied that to the overall volume environment.
So maybe smaller, more frequent orders.
Could be. Cases per line, which reflects penetration within an account, was also impacted by foot traffic issues, but they did say that metric improved in April. The main focus, though, seems to be on winning new accounts.
And they have the sales force to do that.
Seems so. Salesforce turnover is apparently normal historical levels, and they're actually adding headcount there, growing the sales team in the mid-single-digit range.
What about physical capacity? Warehouses?
Like they're investing there. Mentioned capacity expansions and automation, like a new semi-automated facility coming online in Illinois. But they made it clear that current capacity isn't holding back growth right now.
And M&A? Still looking?
Yep. So the acquisition environment is consistent, and they're actively looking for deals. The Jake Spiner acquisition shows they're still executing there.
Did they happen to mention how they performed during, say, the Great Recession as a comparison point?
They did, actually.
Yeah.
Mentioned volume was down mid-single digits back then, but adjusted EBITDA was essentially flat. Highlights the industry's resilience, even in a major downturn.
Flat EBITDA in that environment is pretty resilient. Okay, last point on macro inflation outlook. Are prices still rising fast?
They see inflation slightly higher than maybe previously thought, mainly driven by protein and eggs, but core grocery prices seem more stable, kind of in that 2-3% range.
Okay, protein and eggs driving it. Got it. All right, that's a really thorough breakdown of the US Foods call. Excellent context. Now let's shift gears to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea based on all this.
Okay, let's speculate a bit. Thinking about U.S. Foods' strengths, that diverse customer base, especially healthcare resilience, plus their internal cost-saving efforts.
Right, the self-help story.
Exactly. So a hypothetical trade could be going long U.S. Foods while maybe shorting a national casual dining chain, specifically one that's been showing consistently weaker traffic, maybe seems more exposed if the economy softens further.
Interesting. So pairing U.S. Foods' relative stability against a more vulnerable consumer discretionary play.
Kind of. The thesis is U.S. Foods, with its mix and efficiency drives, is just better positioned to navigate potential headwinds than a pure-play restaurant chain relying heavily on people dining out. Plus, that growing private label business at U.S. Foods.
Yeah, over 53% for independents.
That could act as a buffer for their customers against food costs, which indirectly helps U.S. Foods keep those customers loyal. Yeah.
Makes sense as a relative value idea, but of course.
Of course. Gotta stress this is purely hypothetical. Just an idea sparked by the earnings call. It is absolutely not financial advice. You need to do your own deep research, talk to a qualified financial advisor before ever making any investment decision. Seriously.
Absolutely. Consider that disclaimer firmly stated. So that wraps up our deep dive into the US Foods Q1 earnings. Key takeaways for you. Definitely strong profitability, even with headwinds. Continued market share gains, particularly in healthcare and with independent restaurants. And management's holding firm on their full-year outlook.
Yeah, a picture of resilience and effective execution on their internal plans, despite some external pressures.
We hope this breakdown gave you some valuable insights. What stood out most to you listening in? We'd genuinely be interested to hear your thoughts, so feel free to continue the conversation online.